Gary DeWaal here, and this is Bridging the Week from March 23rd to 27th, and today is March 30th, 2015. Good morning. Developments impacting high-frequency traders dominated news in financial services last week. The Securities and Exchange Commission proposed an amendment to an existing rule that would subject many proprietary trading firms to oversight by the Financial Industry Regulatory Authority for the first time, while both FINRA and the Futures Industry Association issued guidance on best practices for automated trading systems and algorithms. Unrelated, a study by the New York Federal Reserve Bank raised some red flags regarding central clearing. We have a lot to cover this week, so let's get started. The Securities and Exchange Commission proposed changes to an existing rule that, if adopted, would require certain proprietary trading firms registered with it as broker-dealers to become members of the Financial Industry Regulatory Authority for the first time. These would include proprietary trading firms that engage in significant amounts of trading on alternative trading systems such as dark pools. Currently, registered broker-dealers are not required to join FINRA if they are members of a national securities exchange, carry no customer accounts, and have annual gross income of $1,000 or less attributable to securities transactions other than on a national securities exchange of which they are a member. However, income derived from trading through another broker-dealer does not count against the $1,000 limit. The proposed amendment would generally eliminate this de minimis exemption. The proposed amendment do not require proprietary trading firms that are members of national exchanges and who conduct most of their business from such facilities floors to join FINRA if their activity on alternative trading systems is solely to hedge the risk of their floor-based activities and they maintain appropriate policy and procedures. Comments are due on or before 60 days following publication of the proposed amendments in the Federal Register. Separately, both FINRA and the Futures Industry Association published guidance last week to help enhance effective supervision and control of automated trading systems and algorithms. 2 weeks ago, FINRA proposed registration of broker-dealers' algorithmic trading programs, principal developers, and supervisors. Marubeni America Corporation agreed to pay a fine of $800,000 to the Commodity Futures Trading Commission to resolve charges that it filed 38 inaccurate reports with the CFTC of its cash positions from July 2010 through August 2013. Under applicable CFTC rules, persons holding large futures and option positions in certain agricultural commodities, including wheat, corn, soybeans, and soybean meal, among other commodities, must file certain reports, so-called Form 204 reports, with the CFTC, setting forth their cash positions when such futures and option positions are hedging transactions. Marubeni, which claimed to be a hedger, filed incorrect reports of its cash positions in these commodities during the relevant time, said the Commission. After filing incorrect reports, Marubeni, a non-registrant with the CFTC, filed correct reports and, quote-unquote, cooperated in the Division of Enforcement's investigation, said the CFTC. The trustee for the liquidation of MF Global Inc. is seeking permission from the bankruptcy judge overseeing the firm's dissolution to make a distribution of $461 million to unsecured general creditors. If approved, this distribution would result in total distributions to unsecured general creditors of 72% of their approved claims. To date, the trustee has distributed 100% of approved claims of MF Global's customers and 100% of approved secured priority and administrative claims. FINRA fined Oppenheimer and Company $2.5 million for failing to supervise one of its former salespersons, Mark Houghton, who stole money from his clients and overtraded their accounts from November 2005 to February 2009. During this time, claimed FINRA, Mr. Houghton convinced some of his clients to wire funds from their Oppenheimer and personal bank accounts to entities he owned or controlled. In addition to paying a fine, Oppenheimer agreed to pay restitution to customers of $1.25 million and to retain a consultant to help the firm develop better policies and procedures related to wire transfers, registration and termination filings, and excessive trading. Mr. Houghton was sentenced to 34 months in prison in October 2014 for defrauding the producers of the Broadway show Rebecca the Musical in a scheme involving fictitious overseas investors. Citadel Securities agreed to pay a fine of $70,000 to the Chicago Mercantile Exchange because of its entry of an unspecified number of unintentional orders on Globex on June 3, 2013 because of a quote-unquote software malfunction. According to CME Group, Citadel's quote unintentional order entry end of quote prompted it to resend to the exchange orders that previously had been filed, causing an unusual short-term increase in trading volume of the E-mini S&P futures market and its prices. Separately, ICE Futures US fined Trevor Guile, trading as Liger Investments Ltd, $25,000 for a quote-unquote software bug in its automated trading system on November 5, 2013 that resulted in the entry of quote-unquote numerous order messages in the LD1 fixed-price ICE lot futures markets that the exchange's Business Conduct Committee deemed quote, not made in good faith for the purpose of executing bona fide transactions, end of quote. ICE Futures also claimed that Liger failed to identify the software bug prior to deploying the automated trading system. And finally, staff of the Federal Reserve Bank of New York have issued a highly quantitative study that suggests that clearinghouses may not mitigate risk as effectively as bilateral transactions in all circumstances. In particular, says the study, quote, when a small number of dealers trade in a relative large number of asset classes, central clearing may lead to increased counterparty risk and higher margin needs, end of quote. According to the staff study, clearinghouses are most effective in reducing risk when the number of asset classes is small relative to the number of dealers, or if there are a large number of assets, the number of dealers also increases. I cannot say that I understand fully the advanced math that supports this staff study. However, the fundamental questioning in this report of the appropriateness of central clearing under all circumstances raises significant red flags. At a minimum, as this study seems to argue, an optimal clearinghouse requires many clearing members to help neutralize risk most effectively. Unfortunately, in fact, the number of clearing members is decreasing and is likely to decrease further as a result of inconsistent public policy that on the one hand promotes central clearing, but on the other hand penalizes firms that offer central clearing through capital charges. Well, that's it for this week's Bridging the Week. As always, there are more articles and more information in each article on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great April Fools on April 1st, and have a great week overall. Ciao!